Um, Well, welcome everybody to another episode of the Good Deeds Note Investing podcast. I'm your co-host Chris Seveny, and today we're going to talk about converting a contract for deed into a mortgage, deed of trust, whichever avenue that state has. And as part of this, we have special guest Russ O Donnell from at Call The Underwriter. Russ, how are you doing today?
Great, Chris. Thanks for having me this morning.
No problem. First, I'll just mention for those who don't know a little bit about me, and then Russ will let you do an intro as well. As I mentioned, we co-host this podcast, and my background, I've been in real estate for over 20 years. And when I was doing construction management, I had managed over about 700 million in place on some pretty cool large projects. And right now, I'm currently managing a portfolio of about 200 active notes, including having a 506B and a 506C fund to run those through. And my goal is to share experiences and educate people in the note space. And that's kind of the reason, Russ, wanted to have you on today so we can have some good dialogue on converting a CFD to a note from that perspective. So why don't you kind of give people your background and why I have you here today?
Yeah, sure. Thanks, Chris. So I started back in the lending business. I've been doing this lending biz about 21, 22 years, and I started back in 97 as a loan originator. Did that for about 8 years, ran some branches, did some originating, worked with some builders, and then the crash happened. Nobody was originating anything. And at that time I was out developing some land. I grabbed a couple partners and we went and did some land development for about 3 years, and then came back into the business as an underwriter for a large bank, and got a bunch of certifications and underwrote for big banks and big mortgage companies until just after Dodd-Frank hit. We created Call The Underwriter to help small lenders and investors with Dodd-Frank and TRID compliance. Didn't actually take off until about 2 years ago when we met a couple of guys named Dave Franicke and Eddie Speed and Dickie Baldwin, and got introduced to the right people. And we met you, of course, through those lines of communication. And we've been doing that for the last couple of years. About 6 months ago, we added to our portfolio of products a service that actually does convert CFDs over to notes, mortgages, notes, deeds of trust, and we've been doing that. We don't do that on every deal, but we do it as the need arises. So I'm glad you're having this call. It's a great thing to talk about. I think that there's so much going on with CFDs right now that people don't have answers, and it's really awesome that our industry has somebody like you that's taking the time to talk about this.
So one of the questions that I want to throw out there right off the bat is, can you explain the difference between an underwriter and a mortgage loan originator?
Yeah, sure thing. So a mortgage loan originator, by definition, is somebody who takes an application and or negotiates the terms of a potential new mortgage. An underwriter is somebody who takes something that a loan originator originates and does a compliance review to make sure that the terms of that mortgage and the buyer meet Dodd-Frank and other lending requirements.
Okay, so this is a question, and I think people in this first 5 minutes are going to get more education than they've probably gotten, throughout, this whole process of people looking at CFDs, because now everyone always says, oh, if you're converting a CFD or originating a CFD, you need a mortgage loan originator. Is that the case, or do you need an underwriter to confirm you're compliant?
Wow, great question. So and that's the $1 million question. So the short answer is you need both.
Okay.
Somebody has to originate the deal, and that's usually the investor. If you've gone out and you've acquired a property, you're trying to fill it with an owner-occupied buyer. The first compliance piece is originating that deal. Dodd-Frank, the SAFE Act, which governs originators and when you have to be licensed, how many you can do without a license. The SAFE Act will tell you how many you can do, when and where, and that's the origination piece. Once you get it originated, you then, Dodd-Frank says you have to meet ability to repay requirements. So if you can think about this, we talked about the difference between an originator and an underwriter. An originator falls under the SAFE Act, so that's
Mhm.
one requirement, and an underwriter falls under the Dodd-Frank Act. Dodd-Frank is underwriting to make sure that your borrower meets the ability to repay requirement. There
Mhm.
is no exemption from Dodd-Frank. Every owner-occupied deal in a 1 to 4 unit dwelling has to meet Dodd-Frank requirements.
Mhm.
The SAFE Act, there are exemptions in the SAFE Act to where you don't need an RMLO if you're doing so many. Depends on kind of where you are. If the state you are in has an overlay to the federal SAFE Act, but the Fed SAFE Act says you can do up to 3 without a loan originator. There are attorneys. We deal a lot with Bill Bronchick, who's an attorney well versed in
Mhm.
Dodd-Frank and does a
Mhm.
lot of seller finance. And how he structures his stuff is he puts no more than 3 assets into a single entity, which allows him to
Mhm.
stay exempt from the SAFE Act as he keeps going, and he can create an unlimited number of deals. And that, of course, I'm passing on information
Mhm.
there. You need to check with
Yeah.
your own attorney before you go down that road. But
Mhm.
that hopefully will kind of explain the
Mhm.
difference between SAFE Act, Dodd-Frank,
Mhm.
an
Mhm.
LO, and an underwriter.
Okay. So in this instance, when you're converting an existing contract to a deed of trust and mortgage, typically it's the underwriter because everyone keeps saying, "Oh, I got to get my MLO to approve the buyer," and they're technically using the wrong term. It's really the underwriter, correct?
You are absolutely right. Yeah, RMLOs are not underwriters; they're originators. They're salespeople. I'm
Mhm.
licensed in Arizona to be an
Mhm.
RMLO, and RMLOs are salespeople. But it's the underwriter that's going to verify
Mhm.
those terms meet
Okay.
Dodd-Frank requirements.
Okay. Now, can an RMLO qualify a borrower's ability to repay?
Yes, yes. So technically, if the RMLO is familiar with Dodd-Frank, familiar with the lending guidelines, it understands how to knows what the FHA requirements are that Dodd-Frank requires. If they're well versed
Mm-hmm.
in Dodd-Frank and lending guidelines, then
Hmm.
yeah, an RMLO
Okay.
could in effect do that. You just something you have to
Mm.
verify going in up front.
Okay. So now one of the questions that get posed to me a lot is, why would somebody want to convert a contract for deed to, a mortgage deed of trust? Because in a contract for deed, any equity in the property, if they default, you could potentially recover that. And for me, in certain states, there's no added benefits for over a CFD versus a mortgage deed of trust in like Maryland, Missouri, Virginia, Georgia, Florida. In all these states, CFDs are kind of worse off than a mortgage deed of trust. In that case, another is, you want to be a good lender and give them, the equity they deserve. Personally, I think it reduces risk by not owning the property and having your name on it. And I view mortgage deed of trust as more valuable than a contract for deed. Is that kind of what you hear from people out there as well? Kind of these things?
Yeah, you're absolutely right. It's kind of doing a 180. CFDs are kind of doing a 180, and they're not really giving investors what they thought they would give. And more people are converting over to mortgage notes and deeds for a number of reasons. Yep, you're correct.
Okay. And, I got a slide that I put up here is kind of the conversion process. And the way I look at it is, first off, you need to reach out to the borrower to see if they want to convert. I have only had on one instance a borrower who said no. Um, but, that's the first thing. You can't force somebody to convert. And then, you send the package, they execute it, you have to board the loan and then record the documents. And this whole process is not a very simple process by any means. And Russ, we've been, we've got, I've got at least, I don't even know how many, several out there floating out there right now where people can't even get a statement saying that their car payments are current,
Yeah.
as an example of one we're dealing with. But one thing I just want to spend one quick moment talking about is, when you do reach out to a borrower, to ask them if they want to convert, I put together some things that you should do and what you say to them. And what you should do is explain why, and be honest with them, why, and explain the benefits. I mean, once they start hearing the benefits, this is where, the potential tax credit savings, they can turn around and sell the property without your permission, essentially, because again, the deed's in your name. They can turn around and refinance at a better rate. And here are the things that we'll touch base about in a few minutes is, the costs and the timing. And I'll pick your brain in a few minutes on this because there is some cost and timing involved. And you do, typically give them time to think, about if they want or what not to do. And some of the common mistakes that I see is saying it will cost nothing, because if you do, then you're eating those costs. So make sure you understand who's paying for them. Another component is the type of deed, which is, are you getting title insurance? Most borrowers have no clue that they don't even own the property. They don't even know that it's on a CFD.
Right.
Another is setting a time period to this, because as what's your average time period you think to get this process done?
Wow. Well, I think from the time the borrower says yes, um, then you need to submit, who's ever going to draw up your new closing documents, that closing package, the note and the mortgage or note and deed of trust, depending on where you are, whatever their turnaround time is, you've got to factor that in. Then you have to, of course, if the borrower is not local, you've got to make arrangements to get the documents out to a mobile notary who can meet with the buyer. So I would say you're probably at a week already, right?
Yeah.
And then from the time they you get it all done and notarized, assuming it's all done correctly, it then has to get recorded. So, I think most states still now allow you to record electronically. And so, yeah, maybe 2 weeks to be safe.
Yeah. But I would say, that's just once the package is approved. How long does it take you to get a package approved?
So, so on a good question. So on a simple conversion from CFD to note and deed of trust, from the time we get the order, it'll take us 48 hours, up to 48 hours, to produce that loan closing package. Now, fortunately, on a simple CFD conversion, they don't have to go through underwriting as long as you're not changing the terms. It's just a simple security instrument switch. And so we can pump those out in about 48 hours, get them over to the investor, and then the investor, of course, takes it from there and coordinates with the buyer to get them signed, notarized, and then record it. If, say, we've got a CFD and the borrower wants to pull out $5,000 to fix the roof or whatever, it then becomes a refinance. And then we would need about 72 hours to do the underwrite, certify the ability to repay requirement, and then punch out the new set of closing documents.
Yeah. And where I always find the sticking point is when you're doing that component is the documentation from the borrowers and getting that from them. Because
Right.
sometimes you may do this as a mod and the payment goes up by $50. Well, guess what? You have to go through this process. And, I've literally, started one in early March and we're still not through yet. And the first payment was due April 1st.
Oh, wow.
So, you have to be careful in some of these processes to make sure, that you leave adequate time. If you say, if you said today I was converting somebody and you put the mortgage and note first payment due May 1st, you're nuts in my mind.
Yeah, that's not realistic.
You have to think of it as if you're closing on your property, on your own house. Basically it's probably 6 weeks, and from that component. Now, Russ, one question I was going to ask too is, and by the way, one thing I just want to mention, when you're going through this process, make sure you let your servicer know what you're doing, because they need to be in the loop, and I'll explain a little bit why later. So, but so we kind of talk about the application process. And so on a simple conversion of, I'm literally just taking this UPB of $20,300 a month, John Doe who's been paying, and converting it over. in your mind, and from your perspective, if I said, "Hey, Russ, I want to kind of use your services," for the most part, you create. Now, correct me if I'm wrong. You create the closing package. You can also write or provide the mortgage in note, or from that perspective, and provide that. Is that correct?
Yeah, correct. And so when we get a call, an investor says, "Hey, I want to convert this CFD," we set up we have a separate website that we use for that process. And what the investor does is they walk through. It's really kind of an easy follow the bouncing ball, fill in the blanks, and then
Mhm.
upload your original CFD legal description if it's not already there. And with those documents, we can then create the new set of documents. And that document package is going to mirror exactly what Fannie Mae would require in a typical
Mhm.
mortgage loan. So
Mhm.
every single disclosure, state required disclosure, anything to the minute compliant is going to be included in that package. You don't want to miss anything.
Mhm.
And so when that's done, we then email that document package back to the investor for a double check to make sure that everything that the investor is expecting is correct and needed. Maybe they forgot something, but they're going to go through that package and make sure that it's all correct. Any changes, they get it back to us. We then have a 24-hour turnaround time on a final set of closing documents for them to then
Mhm.
arrange with their borrower to get signed.
And the information you need from the lender, from like myself, basically, when you fill out that simple form, is really loan terms, borrower information, um, you know,
Yeah.
property information,
Yeah,
pretty
and
much.
what entity you want it titled in. I mean,
Yep.
sometimes if you've bought a note,
Mhm.
your entity isn't yet reflected, and so our
Mhm.
application process, our
Mhm.
form is going to ask you for what's the
Mhm.
name of the lending entity that you want this in, that if
Mhm.
it's being transferred to, because you bought the note from somebody else. So yeah, we've
Mhm.
got all those questions to make sure that when we punch out that initial set of
Mhm.
documents, it's complete, just with the
Mhm.
exception of a final review from the investor to make sure that it's all correct before we give them a final.
Yep. So for you to do that, what's it cost?
So our cost is $249 for that
Mhm.
document package. And an
Mhm.
investor would start by going to, we have a convert website called convertcfd.com, and they would just start there.
Mhm.
They would fill out the form. That takes them to a payment portal. They pay for it.
Mhm.
Once we get it, we punch out the documents. They get them in
Mhm.
48 hours. Again,
Mhm.
they review them for corrections, and then
Mhm.
24 hours later they'll have a
Yeah.
final.
And if somebody wanted to get the mortgage note along with that, that's an extra cost to it, correct?
Oh, no, no. They
Oh, no,
the
okay.
note and mortgage or note and deed of trust, depending on the
Mhm.
state, is included.
Okay. Is it the deed that was there? I thought there was something that was an extra cost as well. I couldn't recall. Maybe I'm wrong.
No, the only extra cost would be is if we're doing a simple conversion, that the total
Mhm.
cost is 249.
Mhm.
Unless you're thinking about the tip, I do accept tips.
Yeah.
But no, if the only extra
Mhm.
cost would
Mhm.
be is if we're not mirroring the terms from the CFDs, if we're
Yeah.
raising the loan amount and pulling out
Mhm.
cash, it becomes a refi.
Yeah.
And then of course we would charge
Mhm.
our underwriting fee on
Mhm.
top of that, right?
Yeah. So one of the big, and we've had this conversation, is getting this package executed. And who do you use, how long, what's it cost, and some common pitfalls and stuff. So I've in the past have tried to get title insurance. Um, on some of these properties, and I mean, I can't recall if you were on one of the calls that I had with a title
I
company,
remember
but
that. Yeah, I
yeah.
remember that.
So the challenge has been, and you've explained this, and it would be great to explain it again, but essentially, title companies view it as a sale of the property. So they're expecting a full blown like closing. And by doing that, all of a sudden your closing costs like double compared to
Yeah.
this is not a refinance. It's considered, and I'll let you talk about the difference on in that when you're converting, a CFD to a mortgage deed of trust from that perspective, because it's viewed differently in the eyes, correct?
Yeah. So when a title company gets involved, and I have lots of great friends in the title business, and my heart goes out to them because it's people have no idea the amount of work that it is, but it's all about who we're doing business with. And there are some
Mm,
title companies that are investor friendly, and there are a
mm,
lot of title companies that are not. They don't understand what we do, and they're not very investor friendly. And so when a title company begins to look at it, as a refinance, then they begin to move into full blown, mortgage, new mortgage loan, wire of funds. I mean, they're looking at it through the wrong set of eyes. And so, yeah,
yeah.
you're right. The insurance goes through the roof, and now there's escrow fees, and there's just stuff that they don't normally need to do. So it's all about finding the right people.
Yeah, and that has been the challenge I've had trying to find title companies because that has been, that limit of they're like, okay, the prepaid taxes, we need the, year prepaid insurance. And it's like, no, 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 we're just, literally, transferring this. And so that has been, one of my bigger challenges. So here's another question that has come up in the past too. If it's a contract for deed before Dodd-Frank, do you when you convert them, do you need to basically get get them compliant versus if the CFD was after Dodd-Frank? Is there a difference?
Great question. So CFD conversion and Dodd-Frank compliance are definitely two separate issues. For
Mhm,
us to convert a CFD into a mortgage note and deed of trust, um, we're not concerned about whether or not the loan was Dodd-Frank compliant, because that's a whole other issue. All we're
mm,
doing is switching the security instrument. So we're replacing one security instrument
mhm,
for another. So like when you're just converting a CFD to the note and deed of trust, we don't need borrower documentation because we're not verifying their
mm,
ability to repay.
okay.
If for some reason, and we know
Mm,
that probably most seller finance notes on the market today are not Dodd-Frank compliant. They were not underwritten. They're not Dodd-Frank compliant. It
mm,
doesn't require compliance to convert that security instrument. It does if you're wanting to, maybe you want to requalify the borrower. Maybe you're switching the payments up. Maybe you're trying to, get a
mm,
non-performing note performing, and you want that buyer to be Dodd-Frank compliant, from this point forward, which has other benefits. But to just convert the CFD, if you're not changing the terms to a mortgage note and deed, we don't need to collect those documents. We don't need to provide that type of Dodd-Frank compliance.
okay. Now, as part of this transfer, okay, or this execution, can your costs be charged to the borrower?
Yeah, absolutely. It's a bona fide cost. We will always invoice the lender because we have to be compliant on our side as well. We always work
Mhm,
for the lender, and so we
mhm,
will always invoice you as a lender. However, that borrower, when they come to sign those documents, can bring those funds to closing to reimburse you for that cost.
okay.
Yeah.
And part of challenge, so I guess here's one question that comes up is, a lot of times the borrowers may not have the money for the down payment. Can that money be rolled into the loan and still keep it compliant without,
So,
increasing the balance?
so
Mhm,
um, if you begin to roll fees into a loan, you in essence are making a new loan. And so when you
okay.
make a new loan, it's now classified as a refinance.
Yeah.
And so now you have a full blown mod. You now come under Dodd-Frank compliance. Now we've got to
Mhm,
do a whole new
mhm,
underwrite. Um, I think that for investors and for simplicity purposes, if the
mhm,
borrower can't, or you can at least have them, bring in, there's enough
mhm,
benefits in this where I would think that somebody would at least be willing to pay that
mhm.
cost or pay half to
Yeah.
finally get
Mhm,
on title
mhm,
and
yeah.
have those
Mhm,
benefits. But if you can't, it may
mhm,
just be something that the investor needs to
mhm,
eat, or maybe there's some other
mhm.
option that I'm not aware of.
Yeah. In all my cases, I've always picked up the cost. I
Okay.
mean, it's just
Yeah.
been, I've just done it, and it's, I view it as the cost of doing business in that sense,
Sure.
from that perspective. And, it's kind of just, now one of the other components is, when you go to record the deed in the borrower's name, and then making sure, that's discussed who's going to be paying for that bill, because that's a different animal. Because I mean, certain states it's cheap, but you get into like Maryland, Pennsylvania, it could be 600, 800, it can be thousands of dollars, to
Wow.
record some of these deeds. So that's one thing, just people got to be careful of, when they're doing this. It's my understanding that if they would have paid off the land contract, you give them the deed and it's up to them, they'll go record it. Now, is that just in something that needs to be discussed up front, of how that's being handled. But you got to be careful, because if they don't have the money, you roll it into the loan, boom, you're right back to what that comment you just said.
Right.
Um,
Yeah.
what have been some of the common pitfalls for us that, have you seen any for any of these conversions?
I
Anything that's
think,
kind of gone wrong?
yeah. So, I think where these things go wrong, because remember, we're producing a Fannie Mae Dodd-Frank compliant set of closing documents. So the documents are the most popular set of closing documents on the planet.
Mhm,
These are documents that Fannie Mae requires when they buy the loan.
mhm,
So any other investor, we've never had an issue where an investor buying a deal that we did a CFD conversion. We never had an issue
mhm,
with the documents. I think it all goes back to what you said in the beginning, Chris, is just
mhm,
setting up expectations in the beginning of who's going to, what are the fees, depending on your state. I wouldn't assume that recording fees are $100 like in Arizona. I would
mhm,
call and find out, or get on the message boards and the social
mhm,
platforms. There's so many people willing to help to figure out who've gone down this road before. What am I supposed to expect, and how do I negotiate this out with the borrower so I know who's
mhm,
paying for what. We had a large note selling platform company reach out to us a few months ago,
mhm,
and they converted, I don't know, about a dozen. I think it was between 10 and 12. Put a
mhm,
large order into us to convert all of the documents,
mhm,
and so we did. And of course, this took us probably about a
mhm,
week and a half to get them all done, and we get them over there, and then we got a call that said, "Hey, what's next?"
mhm,
I said, "Well, you get together with your borrower." We were pretty
mhm.
surprised.
Yeah.
We get together with your borrower, and you get these signed, get them notarized,
Mhm,
and they said, "Well, what if they don't want to do it?" And I go, "Well, you didn't figure
mhm,
that out before you ordered
mhm.
the conversion documents?" And they said, "Well, no, we just figured everybody would want to do it." And so, yeah, so they kind of put the cart before the horse on that one. So I love your approach, Chris, and just making sure that the borrower wants to do it, and
Yeah,
figure
that's the
out what the
biggest thing.
costs
And
are.
one of the things that I've, been, fortunate on is, especially some of these, CFDs, when these were originated back in the heyday, they typically have a lot of problems, paperwork wise, whether it's missing, lost documentation isn't correct, or whatever it may be. And by doing this, it also allows you to correct any of those sins. So sometimes it's easier than to try and hunt down a certain company that may be out of existence for 3 years, and that individual.
Oh
Sometimes
yeah,
it's easier just to call the borrower and say, "Hey, let me convert you." And then all those sins with that CFD go away, and now you
yep.
just have brand fresh new documentation.
I love
Um,
that approach. It amazes me when I look at collateral files at some of these. I mean, there's lots of lending laws centered around everything that we do, and one of the laws as a lender that you have as a lender is that when you do a transaction for somebody, and this just kind of goes back to some of the notes that note investors buy, and they get this collateral file, and it's got two pieces of paper in it. There's no credit report, there's no application, nothing. Um, and everything that's done with a buyer on a new loan all of those records have to be kept on file, readily accessible for 3 years. I mean, that violation alone comes with a huge fine and can get you kicked out of many states on one deal, just not keeping records on one deal. And so you're absolutely right. I think that, man, that a conversion in that instance, boy, really takes a note that performing or non-performing from a place of documentation really far down the value path for sure.
Yeah. And, at the end of the day, it's not that difficult to process. Now, one thing that now I'll ask you, Russ, is in certain states that, I forget what they call them, but I know like North Carolina and Georgia, technically you need an attorney to do any type of, closing or, uh, you know, execution of like the deed of trust and note and, when a property is, somewhat sold. Do you still have to follow that in this instance, or is it just like, hey, I'm quick clean deeding this over to my brother, I didn't get an attorney involved? Or, because I hear in certain states, these, I forget what they call it, but where an attorney has to be involved, or is that only involving if you're getting title insurance?
Wow, really, that's a really good question. I think that it's probably outside of my area. Here's what I'll tell you what I see.
Mm-hmm.
But whether or not you can or wouldn't go this route is between you and your attorney for sure.
Mm-hmm.
And just keep in mind that when you start bringing up things like Dodd-Frank to attorneys, you'd be amazed at how many attorneys just can't answer questions and they won't answer questions. So hopefully you can find somebody that's Dodd-Frank compliant. When it goes back to the issue that you had at the title company, where the title company is looking at this like a brand new loan, like a refinance of a brand new loan.
Mm-hmm.
And in fact, what we're doing, if we're not changing the terms, you'd be considered, you come along the lines of a modification. Mm-hmm. So let me explain one quick thing, and then we'll jump back to this question. You are exempt from Dodd-Frank. You don't need to follow any kind of ability to repay requirements, as you know, when you're doing a loan modification, meaning that the payments remain the same or the payments go down. There's no Dodd-Frank requirement. There's no going back to the closing table. There's nothing like that. The note, the deed doesn't change. If your mortgage company does a mod, they send you 2 pieces of paper. They explain the terms. You sign it and send it back. It's not notarized. It's nothing. It's that easy.
So on a modification, just so I understand this properly, if the modification keeps the payment the same or drops it, Dodd-Frank does not apply. If it goes up, it does.
Does not apply, correct. If you raise the payment by a penny, Dodd-Frank applies. If you don't, it does not. Good
now
question.
that's raising only the principal and interest, because escrow may change and go up. Escrow is kind of exempt, correct?
That's correct. Yep, principal and interest only.
Yep. Okay.
So now coming back to our original question is, do we need an attorney to convert a CFD over to a note and a mortgage? It goes back to the title company situation where they're going, well, is this a new loan or is it not a new loan? And so the attorney then looks at it and goes, well, gosh, is this a new loan or is it not a new loan? And so in essence, what we're doing is, if we had to go one way or the other, and we aren't, we're just simply changing the securities. But if we had to go one way or the other, and we're not changing the terms, we fall under the line of a loan modification. So then you have to go back to that state statute and go, okay, if I do a loan modification, do I have to use an attorney to sign and execute and prepare these new set of loan documents? And then whatever that answer is the way you proceed in that state.
And that was the challenge I was having with the title company, is we view it as a mod, they're viewing it as a new origination or refinance.
Exactly.
So here's a question for you. Now, with contract for deeds, there's two ways I've seen them in the past. One is you have the contract for deed that acts as also the note. And in some instances, they issue a contract for deed and a note, which, is when every attorney I ask says that is just completely confusing. And, basically it should just be one document.
Right.
So in that instance, we are canceling that land contract. That note really kind of goes away as well, and we are issuing a new note, but it's just a continuation or a clarify. Basically, it's a continuation of that existing one, essentially. So even though, are you issuing a new note technically, and that's not really, but it's not really a new note. You understand my question?
I do understand it, and I think that whoever put a CFD with a note,
Mhm,
went,
mhm.
didn't really go above and beyond. They really kind of created a hot mess because they're one and the same. All a note
Yep.
is a security instrument, just like the CFD, as you know.
Mhm,
And but there are state laws that
mhm,
say if you create a new note,
mhm, mhm,
you create a new note over an existing note, again, is this a new loan,
mhm.
right? Or is it a
Yep.
is it a modification? And so
Mhm.
again, it all goes back to did you change the terms?
Yep.
So when we do a conversion
Mhm,
on the new note,
mhm,
at the bottom of everything, right above where the borrower signs the new note, we
mhm,
insert a paragraph with verbiage
mhm,
that says that this note supersedes the existing CFD,
mhm,
contract for deed, dated blah blah blah, with an
mhm.
original balance of blah blah blah. The current unpaid balance as of today is blah blah blah. And
Yep.
so there's very specific language in there
Mhm,
that
mhm.
reinforces the fact that all we're doing is simply replacing a security
Getting
instrument
instrument.
for another
Yep.
security instrument, and the note
Mhm.
and the terms haven't changed.
Yep. So good. So one thing I just want to quickly talk about as well is, there's a whole other side of this, which is dealing with your servicer. Um, so Russ, I'm working with you, get this in the borrower and so forth. And, you got your servicer out there. And some people will try and have their servicer manage this process as well. And I recommend against that, honestly, because it's, you're bringing too many people into it. It's like, okay, I get the information from Russ. Now I'm going to send it to servicer to get the borrower to execute this. Trust me, don't do it. My recommendation is you let them know what's going on. You send them drafts of things, and you send it directly to the borrower. And you also, or what I usually do is I find a local mobile notary. I send it to them, and
Yeah,
then they coordinate with the borrower to get it, to get that date, to get them over there to sign it. They return all that stuff to me, they scan it, then I make sure I send it to the servicer, because one of the things people don't understand with the servicer, and again, everybody views what this is differently. A servicer views this as a new loan. They don't view it as a modification. So what they do is they close out that old loan, and then they put a new loan in the system. They charge you a deboarding fee. They charge you the boarding fee. They put the new loan in the system. And sometimes they'll even be like, oh, do you have the borrower's contact information and the escrow information? And then you have to turn around and say, it's, basically, and I tell them it was loan XYZ123. Now it's just XYZ234. You have that information. And they're like, oh, okay. Um, and again, this is also something you got to take into consideration, because when you're doing all of this, again, there's more costs involved. That those costs you can't charge a borrower. So one of the things I just want to mention to people is you really don't want to do this on a loan with like a $5,000 balance on it, because you may end up paying $1,000 in costs on a $5,000 loan that's left. So it's something that you have to understand. You know, throughout this process is, and that's why I mentioned, you need to reach out to everybody, including, your underwriter like you, Russ, the county that's getting recorded, the servicer, and put all this little together, because, paying you $295, you get the recording fees, which could be $300-400. Plus if you use a third party like KDK or Orion, there's another 175. You've got, $50 D board plus $100 board. There's another $150. So next thing you know, and you're at 3, 4, 5, you're at $600-700, without blinking
easy.
an eye.
Yeah.
And then you do say you're doing 10 of these, that's $6,000-7,000. It starts to add up. Someone did ask a question about online notaries as an option. That's state specific. During this time, you potentially could use an online notary, but it really depends on the state. I'm actually using one next week, but in Maryland, where I'm in Virginia, and Virginia doesn't recognize them. So good question, Joe, but it's really, you just got to kind of check. What I would do is, call a local notary and see if they can do them online as well. So,
Yeah.
and then the other component to this is, what most people forget is, if the CFD is recorded, which in some instances it is and isn't, the other thing a lot of people forget is you have to get the cancellation of that CFD. A lot of people forget that. And if it's recorded, you want to make sure that gets recorded. Another component is people, record stuff out of order. You got to record the deed before the deed of trust. One thing I'll mention is never let the borrower record the documents. And why do I say that? Because what if they record the deed and not the deed of trust? Then they own a property and they just took the mortgage and ripped it up. The last one, and I made this mistake once, and I waited to get the documents recorded before sending them to the servicer, and all of a sudden and then the person kept making payments, and it was getting credited to the CFD and not the mortgage. So that creates complete chaos, and that was 100% on me. But think about it this way: I have the CFD, which I canceled, but the servicer was putting the payments there, and I have this new loan in the servicer's mind, which is really the modification in the in our world we're talking right now. So I actually had to cut the checks back to the servicer for them put in the system and then send me the money back. So.
Wow.
So it's been, that's one of the things. So, we've kind of went round and round a little bit on things. So one of the things, so if I understand this process, and this is really breaking it down to simple terms, somebody reaches out to a borrower, hey, I want to take your $300 a month payment and, basically keep everything the same, but I want you to be on title to the property. And they say, yes, I'm good. I go to your website, fill out all the information, send you the $295 plus a tip, and you create, you like that, don't you? You create a compliance package that includes the mortgage, the notes, and actually, you know what? Let me see if I can open one here. Conversion docs. If people can see my screen. I'm sorry. Fee is $249. Okay. Thought you charged me $299. No.
I charged you $299.
Yeah.
Everybody else is $249.
Yeah. So, so I've got up on my screen. Okay. So I've got a 58-page document on my screen that has kind of these closing instructions. This is what you provide, essentially. I think this was from you. So it's got the loan amount. So I send you the information. You spit out this 50, 60-page document that includes all this information in it, essentially. I then, you'll have to edit that out. I take this information and then basically print out the mortgage deed of trust, get it signed, as well as get a cancellation of contract, which you don't do. So that's another component to it. Get all of this stuff signed and basically get it recorded and you're good to go.
That's it.
That's, so it's pretty basic. And again, I think where people get tied up a little bit again is when they go for the title insurance component, because it can really start to cause heartache. And that's where I was getting caught a little bit for a time being on things and having the challenges from that. So that's the one place, if you're not going that route, if you're going that route, you know, and again, that comes back to cost as well, because there's a lender's policy, and are you getting an owner's policy on top, and are you getting it for the owner because you can't add it to the loan? So there's
Right.
that whole component. So um, okay, so we've been about 45 minutes, and would like to wrap up. If people have questions, please put them in the chat. Any kind of final thoughts for us, from things that you see, or, from people, or things that could make things more efficient?
Yeah, I think that maybe just a couple things, and one was just to recap one thing that we talked about, and this should make sure that if we're doing a conversion of a CFD to a new note and a mortgage or note and deed of trust, if we're not changing terms, the only thing you need from the borrower is a signature, and to find out what portion of the fees they're going to pay and have them bring them to closing. We don't need a bunch of borrower documents. There's no application. We're going to get that information off the original CFD and when you fill out the form. So you don't have to tap the borrower for all their loan docs and their pay stubs and their all that. There's no qualification on just changing the CFD to a note and a mortgage or note and deed of trust. The second thing would be going back to why they might do it. One of the benefits that you can talk about when the buyer's thinking about whether or not they can do this. We recently had an investor called us to convert the CFD to a note and a mortgage, because the borrower had gone down to their bank to get a second mortgage to do some home improvements, and they had good credit. They were lendable. They were bankable. But the bank would not lend on top of the existing CFD. They would not give them a new second mortgage until they had it converted over to a note and deed of trust. And so I think one of the components I think sometimes we skip is hey, this borrower maybe has 20, 30, 40, 50% equity in this home, but can't get to it if the underlying mortgage or the underlying security instrument is a CFD. We just ran into that recently.
Yep. So one, and I'd like to have you on later on another point in time to talk, because a lot of times when people do these modifications or these conversions, they do increase the price or they roll in the fees. And in that instance, that is the full-blown application process, correct?
Correct. Yep. And then when you do that, once we get them through underwriting and we provide that Dodd-Frank ability to repay certification, then once that's done, we can then print, the new note and mortgage, note and deed of trust, so that when they execute that, they are doing a brand new loan, but they're doing it the right way.
Yep. And when I talked earlier on, that's, about, and that's what I was actually referring to everyone about. I've got one where I'm converting from the husband to the wife. And, so basically it's technically a brand new origination. So we had to go through the loan application process. And that's the process that, again, takes a really long time to do. So probably have you come on again, because we can talk through that process, because that's a whole another animal that we can talk about,
Yeah, sure thing.
because that it has a lot more, especially for there's a lot of people on here who take back these properties and they turn around and they can't sell them, or they'll sell them owner finance. So it's a very good tool, and that's again something else you do or service you provide as well for people, which is I think
Sure
very
thing.
beneficial.
Yeah, love to come back.
Okay. So a question came through. It is only a security instrument conversion if the payment interest rate, borrower, and months remain stay the same. I think the question is the months remaining. The months remaining can change, correct?
Yeah.
Yeah. So
Yeah, correct. You can change
yeah.
as long as the payment doesn't go up.
Yeah. So the payment can't go up and the UPB can't go up, correct? The unpaid balance.
Correct. Exactly.
Yeah. So the months. So basically, if you have a loan with a $20,000 UPB at $300 a month, you can't keep it $300 a month and say that loan had 5 years left. You can't take that loan and say it's $300 a month because the unpaid balance. So it's really interest rate. Keep the payment the same, continue to pay, but change interest rate. Well, that would change the payment though. So from that perspective.
Hey, your
Well,
audio
actually,
is
no.
shut out.
Let's,
about the last 10 seconds. I don't know if
oh,
anybody else.
oh, sorry. Can you still hear me?
Yeah, you're better now.
Okay. So here's a question for you. What if, and I think this is hypothetical. So you got that 20 grand at, 6% at $300 a month. Could you do 20,000 at 10%, but keep it $300 a month and extend the loan? To me, that seems a no-no. But the payment,
So
the
you're
UPB didn't, the UPB stayed the same, the payment stayed the same, but your interest rate went up, so it extended the term of it technically extends the term.
so you don't have a Dodd-Frank issue ability to repay because you're not changing the payment. However, I believe that you would qualify as a new loan by raising, you're increasing the total amount the borrower's, coming
Pay.
back
Mm-hmm.
is paying back. I mean, you have a new till.
Yep.
You have a new till figure. You have a new APR. You have a new everything. I would argue to say that you would need to get that done with a really good explanation.
So I guess the simplest way to break this down, people, is if you are literally just taking everything that is there and keeping everything the same, and behind the scenes, instead of it saying CFD on the top, it just says mortgage and a note. That's really it. Once you start playing with numbers, now it's one thing, like, for example, if the payment was $302.27, it's like, okay, let's make it an even 300 for simplicity. Or the UPB is $22,216.91. Okay, I'm just going to make it flat 22,000. You drop it down just to keep the numbers a little, if you're like, from that perspective, that's kind of just small adjustments again, but you adjust everything down, a little bit. If the payment was 302.21, yeah, I'm just going to get 302 or something along those lines. But, basically you want to keep everything, status quo. You can go in the other direction and change from the status quo, but you're just kicking yourself into a whole different ball game. You're kicking yourself into a new origination at that point in time, and then that's a whole different process, as well as more costs involved and other things. And from there, I'd say you got to be careful because, and again, this goes with experience in doing these things. If you tell the borrower, oh, it's not going to cost anything, but your payment's going to go up, we agreed $50 payment increase, all of a sudden it's like, oh, now you have to go through that new origination. Now all of a sudden you got to go back to them and say, oh, now I need your bank statements. Now I need your 1003 application. Now I need your W-2s, or your taxes and stuff. Then they're going to be like, whoa, what are you doing? I thought, so, and again, when you think about you applying for a loan, that's pretty much a lot of the stuff you got to provide. Okay. Someone said, if you were already considering doing a mod on a CFD, would you do that first, keeping it as a CFD, and then later do a conversion? So here's a thing that I don't think most investors know. When you do a loan modification, no matter what the instrument is, and you increase that borrower's payment, correct me if I'm wrong, Russ, technically you should be going through the ability to repay process, correct?
Yeah, when you raise the payment, you have to verify ability to repay. So you can call it a loan mod, but it's not a loan mod. It's a refi.
Yeah. So if you're doing, so say you got a borrower who misses 6 months of payments, and it was $300 a month. And sometimes what you get sometimes the borrower will say, hey, I'll pay an extra $150 a month till you caught up. Great. Okay. The borrower agrees to that. You didn't put anything in writing or, anything, but if you give them an actual loan modification that says your new terms are $450 a month going forward from $300, you should be getting that borrower approved based on the ability to repay.
Yeah, absolutely. I mean, if they had problems making the prior payment,
Now here's the truth and reality for everybody out there. I don't know one person that does that. Now, on the flip side, it's not too often you have a borrower who you take who wasn't paying and increase their payments anyways. But there's times when a borrower hasn't been paying and then they get a new job and say, "Hey, look, I can pay, and it's a $200 a month." Say, "Hey, look, can you make it $300 a month?" And they're just like, "Yeah, I can afford that." And most of the time, the lender is like, "Great." Then they send it to servicer, "Hey, do the loan modification. It's going to be $300 a month. Here's a new payment." Nobody's gone through that process. So it's kind of a dirty, I think it's a dirty little secret. And the question is like, okay, how did you know? But if that's the case, for the ability to repay, I mean, again, you should be getting, in that instance, you should have somebody taking a look at that. And, if someone wanted to go through that, Russ, what documentation would they need, just out of curiosity? I know we're going a little off subject, but I was just curious.
No, it's okay.
Mhm.
It's really just four items. It's the
Mhm.
application,
Yep.
it's the borrower's authorization so that we can pull credit,
Mhm.
it's the income documents,
Mhm.
which is usually a pay stub and 2 years
Mhm.
of W-2s, and
Mhm.
then the terms of the new loan.
Yep. So this rolls into someone asked, okay, but if I keep the payment the same but raise the principal balance on the loan through the modification, would that, and now that's a question I would say, if it was done before Dodd-Frank, would you need to versus after? Or so say somebody had 20,000 and you had to pay the taxes and all these other, payments for some period of time. So their advances are 4,000 and you're like, okay, your payment's $300, but I'm rolling that $4,000 into the unpaid balance, the 24,000. So the payment stayed the same, the interest rate stayed the same, but the balance went up on the loan on the modification. That's still technically considered a refinance, correct?
Yeah, it's still a new loan. I mean,
Mhm.
you can always raise the balance and still come in even with a lower payment. If
Mhm.
people have been paying on it for a while and
Mhm.
your rate goes down and they're paying off
Mhm.
some stuff and rolling in some fees, it's still a
Mhm.
new loan when you do that. Yeah.
Yeah. So yeah. So to answer your question, technically yes. Now, um, and again, how many people do it, or get somebody to approve it? Now to confirm, well, let's ask this question, Russ. The ability to repay, can that be done by the lender, or can that be done has to be done by somebody who's an underwriter, or, and it does have to be an underwriter in that state, or is it federal? How does that work?
Great question. So the CFPB's requirement, we keep a copy of the CFPB's guide on how to comply with the ability to repay on our website. That's currently down right now, so don't go there. Our engineers are trying to get us back up. But the guide is a really good guide, and it simply says that if you're ever, hauled in before, a regulatory committee or there's an
Mhm.
audit, or the borrower simply challenges and says, you didn't make sure I could afford it, because that's our
Mhm.
responsibility now in the day
Mhm.
that we live. You're going to be asked two questions, and those questions are, um, what underwriting methods did you use to ensure that the borrower had the ability to
Mhm.
repay? And so the answer to that question is you don't have to hire an underwriter. You can
Okay.
underwrite your own loans. However, the CFP does go on to say that how you calculate income has to mimic FHA guidelines. How
Mhm.
you do residual income has to mimic VA guidelines. So
Mhm.
if you're familiar with those things, maybe you've got some underwriting experience, you can do your own
Mhm.
stuff and the guide will make perfect
Mhm.
sense to you. If you don't, it's cheap
Mhm.
enough to hire somebody else to get it done and get
Yeah.
it certified.
Yeah. So, and again, I saw in a package that you provided, kind of, basically that VA residual component is you take like the gross income, you take their expenses, and then you take like the square footage of the house times like 14 cents for maintenance costs or something. And
Correct.
then each state or each region with the VA says how much disposable income they should have, and kind
Correct.
of throw all that out there. And I've actually used that, in the past on in mediation cases with borrowers who I'm going to foreclosure on, and they ask for a loan modification, and they want to know, hey, because I know that question is going to come, and it never has actually. It's, did you consider a mod? And I say, basically said yes, they weren't approved. Nobody's ever asked me, well, what criteria did you use? I'm surprised, honestly, but I have that in my back pocket and say I used basically, the FHA and the VA, kind of this VA template to show, hey, and then, basically you got the, whether it's 30, I think it's 41% with debt to income on the VA or whatever it is, show that form. And 99% of times, if the person, their loan debt to income is like 60%, so they're not even close.
Right.
But that's, something that people, when you're doing a mod, I think it just goes back to the standpoint of, just think about from this perspective. The person says, the person has been paying $300, they want to pay 400. Do you just take their word for it? I mean, I don't. I'm like, okay, you got to prove to me and show me you can afford 400 when you couldn't afford 300. That's really what you're doing. I mean, but there's certain steps to go through that, which again, we may have a whole nother episode on that, Russ. So, I'll keep you busy on some of these things.
Sounds
So,
good.
okay. Well, any other questions, people? It's, been on for a little over an hour and stuff. So, well, I think I answered everything. Russ, thank you for being on today. And what's the best way for people to reach out to you?
Good number is that what you asked me? A good number?
Yeah, good number or email.
Good number, phone number 480-388-6018. And the email is russ@calltheunderwriter.com.
Okay. Well, thank you everyone for joining us today. Take care, stay safe, and if you have any other questions, again, I strongly recommend you reach out to Russ. Very informative. But again, use him as a client, not just as a resource. So,
Anytime.
okay.
Thank you, Chris.
Yeah.
Appreciate you having us.
Thank you.